Matt, things to consider when looking at ARMs versus fixed rate mortgages. First off, can you explain what an ARM is?
Yeah, so an ARM is an adjustable rate mortgage. It's different terms that the banks offer to give clients an alternative option other than a fixed rate payment, which is the opposite. In times like this, with rates higher than what we're used to seeing, people try to think outside the box or come up with a different game plan as far as how they're going to handle their mortgage when they're purchasing a home to make it more affordable and less of a payment shock, if you will. So that's where the conversation for adjustable rate mortgages starts to tick up. It starts to become a very regular thing.
As far as a spread, usually what's the difference between an ARM and the traditional rates? Is it 1%? Is it 2%? Is it half a percent?
I traditionally, on average, see about a 0.5%
Okay.
is on average. Now, you will find that certain banks at certain times have promotional adjustable rate mortgage programs where there'll be one particular bank that's just really pushing for that type of product, and they'll have a big spread, a larger than average spread between the rates.
Wow. And so, Matt, with the adjustable rates, right? How long are usually the terms? Obviously, there must be different programs. Is it 2 years, 3 years, 5 years? How does that work?
Basically what happens is the bank advertises a lower than market rate for an initial period. So there's a 3 year, there's a 5 year, there's a 10 year, there's a 7 year, they're called 3-1, 5-1, 7-1, 10-1 arms. And basically what they're saying is that we will give you this low introductory rate for whatever that 3, 5, 7, 10 year term is. And then after that, the rate can adjust every year a maximum of 1 point per year for the remainder of the mortgage. And that adjustment, to clarify, can go up or down. So it can go down 1% or it can go up 1%.
Does it usually follow the market or does it go?
Yes.
Okay.
Yeah, whatever the market is, in the moment of the adjustment, when that adjustment period happens. Adjustable rate mortgages, it's very easy to get into a revolving door of a mortgage. And what I mean by that is that if, let's say you do a 5-1 arm, you take a great rate, you still have to qualify based off of the whatever the market rate is in the moment. So you don't qualify for more money because you have a better interest rate for the first 5 years. That doesn't play a factor into your qualification. If you get into a 5-1 arm, what happens is after 5 years, if the rates haven't come down and you're not going to have an adjustment where the rate goes down and you're looking at an adjustment that the rate goes up, you tend to start to look at refinances right away. You feel this urgency to refinance because this house, you took the adjustable rate mortgage to get a better interest rate and a better payment from the beginning, and all of a sudden it becomes more expensive than you ever imagined because it's actually higher and adjusted. And what people tend to do is they tend to jump back into an adjustable rate mortgage because those rates are lower for the first 5 years than a fixed rate mortgage. So you do that, and then all of a sudden the surge to refinance happens, and now you're just always going into an arm every 5 years, which is a revolving door, and you never actually trim down the term or how long you're paying this mortgage for, because your mindset is now to go back into an adjustable rate mortgage. So in essence, you'll pay way more in interest if you're always going back into an arm because you're just always stuck into a 30-year term. If you're going to be into the house for a long-term time, instead of getting into a revolving door of a mortgage with an adjustable rate, I think the more popular, better, smarter decision is to get into a fixed budget so it doesn't adjust on you and you don't have this sudden urge to refinance after a 5, 3, 5, 7, 10 year period, and you can budget according to whatever that fixed payment is.